CommitToWealth.com, creating a legacy by committing to real estate wealth.
Hello, everyone, and welcome back to another episode of the Commit to Wealth Podcast. This is your host, Juan Vargas. And with us today, we have two awesome guests, two people that really know what they're talking about in the real estate space. Specifically, they're in the tax side of things. So with us today, we have Brandon Hall and Thomas Castelli. So Brandon is the founder and CEO of the Real Estate CPA. He works with real estate investors. He also syndicates his deals. He works with syndicators and private equity funds to optimize tax positions and streamline accounting and business functions. And Thomas's bio, I'll tell you a little bit about him. Thomas Castelli is a tax strategist and a real estate investor who helps other real estate investors keep more of their hard-earned dollars in their pockets and out of the government's hands as well. So Thomas and Brandon, man, welcome to the show.
Thank you for having us today.
Yeah, thanks for having us, Juan.
Hey, man, it's a pleasure to have you guys on. You guys are definitely doing some really good things out there. One thing that I want everyone listening out there is they're also pretty active in the BiggerPockets space, in the BiggerPockets community. So Brandon specifically, he's written several different articles for BiggerPockets, and they're all very, very helpful. So how many articles have you written, Brandon? Like up until this point, maybe?
Oh my gosh, I have no idea. Probably 30, 40 on just BiggerPockets alone, I would imagine, and then probably 2 or 3 times that on our own website.
Yeah. So, and the reason why I know is because I've come across a bunch of them, and it wasn't something that was just here recently. It's something that you've been doing for a pretty good while, at least for the last 2-3 years, something like that, right? So, a lot of really, really good information. So, if you ever look up anything on BiggerPockets, that's it has something to do with taxes. I have no doubt in my mind that Brandon is going to be, behind one of those articles or one of those, even one of those forum posts as well. So guys, welcome again. Before we get started, hey, why don't you tell us a little bit about your backgrounds, each one of you, and maybe we can get started with you, Thomas, and then we'll get with you, Brandon, as well.
All right. So my name is Thomas Castelli. I'm a tax strategist at the Real Estate CPA. My main role is helping real estate investors minimize their tax liability. I've worked with clients anywhere from one single family property all the way up to clients who have portfolios of single family properties, syndicates, and also flippers, agents, you name it. Work with. If it's real estate, we've worked with them, and it's definitely exciting thing to do. Be able to save people money in taxes. Now, on the other side of it, I am a real estate investor myself. I have invested in a number of properties as a limited partner and was part of a syndication team that did syndicate an 82-unit property in Jacksonville, Florida, currently under management, looking to take it to market within the next few months. So that's going to be exciting as well. That's pretty much me in a nutshell.
Okay, great. Yeah. I mean, that's, and what's beneficial for each one of you. And I know, Brandon, I know your background and you're about to share it with us as well, but what's beneficial for both of you is that, you guys are experts in the tax side of things, right? And that's something that a lot of us don't really 100% understand, right? So, we get the high level side of things, but you guys know way more like into details. And then you're using that to your advantage whenever you're investing and finding opportunities to invest in and bring in partners to invest with you, right, as well. So you get the best of all the worlds combined. So it's a really, really good combination of things. So Brandon, tell us a little bit about your background as well.
Yeah, so I am the CEO, founder of the Real Estate CPA. Launched the business in 2015. Was kind of moonlighting while I was at the Big Four, and then went full time into it in 2016. A lot of our growth, at least initially, was fueled by a lot of the BiggerPockets content, the podcast that I was on over there. And we just kind of took that and ran with it, built out our own content platform, and just really trying to get the word out that we're rock stars of what we do from a tax planning perspective. We help a lot of investors save a lot of money in tax. But yeah, so I've got a team of 12 now. Tom is on the team. We are decentralized. We're a virtual CPA firm. We're all across the United States. We work with clients all over the place. I think we have about 400 or so clients at this point. So our firm works solely with real estate investors across the United States. We work with super small clients that own just one single family rental. We also work with quite a few really large clients, sometimes up to a 10-figure asset holdings amount. So really cool space that we're in here.
Yeah, so it's a pretty big amount, pretty big gap, from your clients, right? So it's from smaller people to larger groups for sure. Real quick, what's one of the reasons why you guys decided to kind of keep everything kind of, I guess you could say virtual, kind of remote, without having like a central location for everybody? Does it work easier that way for your clients, or maybe for your business, or what's the main reason for that?
Yeah, I mean, I guess I'll let Tom kind of talk to it on the receiving end. I mean, as the owner, my experience at the Big Four was, I had people that I managed. People would come into the office, and we would primarily hold them accountable to the time that they billed, and that's not a really great metric at the end of the day. And what I realized through that experience was just that, even if you were at the office, I'm not like looking over their shoulders every second of the day to see if they're on Facebook or if they're actually working. So my theory in building out this firm was, what I could do instead is just hold people accountable to results. So forget the time tracking, forget the showing up to an office. It really doesn't matter if you can drive results. So that's kind of been the whole philosophy behind the build out. And I think it's worked pretty well. I mean, we've scaled pretty rapidly. I've got our team of rock stars that deliver a great client experience and a great product to our clients.
Awesome. Yeah, no, I can see that as well. And, and not only that, but you also get to reduce some of your costs, right? Some of your, your overhead, right? So some of those expenses that it could be unnecessary for you as well. So, then
we kind of reallocate that overhead right back into like big team trips and things like that. So I don't know if we actually net save anything there, but
yeah. Hey, but that's a good thing, right? If you can. Yeah, it gives you that flexibility. So if you can save it, and kind of reallocate it to do something for the team, I mean, that's even better. That's a whole lot better, right? It's better than, going to something that's not going to be useful, really. But okay, great, man. So obviously in the tax world, I mean, there's so many different things that we could talk about. I mean, we can go on for ages, it seems like. But, I want to, I guess, diving into a few different things, and specifically, there's this term that's called the real estate professional status, right? That we can have as real estate investors. So maybe have one of you touch on that. What exactly does that mean, and how do you qualify? What are the different qualifications that you have to have in order for you to be officially a real estate professional?
I can take that one. So the real estate professional status, in a nutshell, what it does for you, the benefit of being a real estate professional, is it allows you to take your losses from your rental properties or investment properties against your ordinary income. In many cases, that might be income from a W-2 job, or perhaps your spouse's W-2 job, or another active business that either you or your spouse run. So it's super powerful when you combine it with something like cost seg, which I think we'll get to in a little bit. But to qualify, you need to work at least 750 hours in a real property trade or business. Those are generally going to be brokerage firms, property management, construction, development, rental property, leasing, things of that nature. And then not only that, there's actually a second part. Okay, and let me back that up for a second. So it's 750 hours, and it has to be more than half of your working time. That's the key piece there. So even if you work 750 hours in a real estate business, but you're working, say, 2,000 hours or 2,080 hours in a full-time job, you will not qualify. The time you spend in a real estate business needs to exceed the time you spend in other non-real estate related businesses. Now, there's also a second component to this that everybody has to be aware of. It is the material participation component.
Sorry. Sound effects.
Yeah, just because you meet that first test, that 750-hour test, doesn't necessarily mean you can actually take the losses. Because in many cases, you might have a real estate, a real estate agent, for example, who might meet and exceed that 750-hour mark, but doesn't actually spend any time on their investment properties. They might delegate that all down to a property manager who handles a vast majority of that. So the second piece is being able to prove that you materially participate in that activity. There's a number of tests to get there. Generally, the one that most investors want to aim for, because it gives you a lot of flexibilities across a lot of different areas, is that you're spending at least 500 hours in rental property services across your rental portfolio. not to get too technical here, but there is a grouping election that you would make as a real estate professional to group all your rental properties together as one in order to meet that 500-hour requirement across your entire portfolio.
So how are people supposed to keep track, like for the IRS, in case, something like an audit comes up or whatever, how do we keep track and prove that we indeed are meeting these minimum requirements as far as the hours are concerned or something like that?
Yeah, you definitely have to keep a time log. You need to keep it as you go. So you need to record your time as you go. One of the biggest things that the IRS is going to look at is, does your paper trail align with your time log? So if they pull your credit card statements and your credit card statements show that you're swiping, at restaurants in London while your time log says that you're doing repairs on your rental property, obviously they're not going to be able to trust that time log. You're going to lose that case. So you just need to make sure that you are recording your actual time, that you don't record it 5 years later, because that's when you run into the issues that the IRS will most certainly try to uncover there. Like, how can you remember 5 years from now what I was actually doing on 10/23 at 1:17 p.m.? It's very difficult to do unless you do keep that time log as you go. So we have templates that we provide our clients. There's also timekeeping tools out there like Toggle or something like that some of our clients will use. But you just have to figure out what works best for you. Keep that log as you're working on the rentals. Keep notes. And if you do that, you should be okay.
Okay. So if you are focusing on this full time, right, you still have to keep a log no matter what. But if you are doing this full time, is it something that you still have to? Is it as important as versus if you have a W-2 job, right? Let's say you have a W-2 job, but you're also meeting the minimum requirement for real estate professional status, 750 hours. I would think that's pretty important to keep a log. But if you're doing this 100%, this is all you do. Is it as important, or would you say it's still very important to do?
Yeah, so it's still critically important to keep a time log. We do get this question all the time, but the IRS is still going to ask you for a time log, even if you are doing it full time. That said, if you're working in real estate full time, you definitely have a better chance of substantiating the fact that you are a real estate professional, but you still need to keep a time log. They're still going to ask for it. It is a little bit of a headache, but again, we say do it now. Don't do it 5 years from now.
Do it now. Don't do it 5 years from now. That's very important. So you said also the tools that you use, one of them was Toggle, but then you also have your own timesheets that you guys use for and also share with your clients. Is that that's another way? Got it.
Yep. We've built out our own tools that we share with our clients. Yep.
Okay, so what are the benefits? We talked about what a real estate professional status means and how to qualify, but what are the real benefits for somebody qualifying as a real estate professional?
Yeah, so kind of what Tom was saying earlier, you've got the real estate professional status. You first have to achieve that. That's the 750 hours, greater than half your time. But then the second piece is that material participation. So really, if I hit that material participation, if I materially participate in my rental real estate activities, then the losses coming from the rental real estate activities become non-passive. And it's really important to note that if I'm a real estate professional, but I don't materially participate in my rental real estate activities, my losses are still passive. That's the piece that everybody always forgets about. You have to materially participate in your rental real estate activities, and then your losses become non-passive. When my losses are non-passive, I can offset any other income that I'm earning without limit. So it's really great in years where we're doing like a cost seg study and 100% bonus depreciation, or maybe I have my own portfolio built out and I'm starting to invest in limited partnerships and I'm making an aggregation election to get a lot of bonus depreciation with each partnership that I invest in. So there's a lot of different strategies there once you do qualify as a real estate professional and materially participate in your rental real estate activities.
So in other words, what you're saying is for example, if I am married, right, and I qualify as a real estate professional, then my wife's income at her W-2 can be offset because I'm qualified, and they have become non-passive. Is that a fair statement?
Pretty accurate.
Okay, so this is when it becomes really, really beneficial to try to qualify, right? To try to qualify and make it happen, because you can really help yourself out so much on the tax side, and that's one thing that's huge. As one of the greatest benefits to real estate investing is you get those kind of benefits, those kind of tax benefits specifically. Okay, great, and so. Can you elaborate a little bit more? We just said non-passive versus passive. Can you elaborate a little bit more on what the definitions are exactly?
All right. So yeah, I could give a little bit of an overview of that. So whenever you invest in rental property, the losses from the investment in real estate, or from the rental property rather, are considered passive losses, and it can only offset other passive income, which for the most part for real estate investors is going to be rental income from other properties. Could also be limited partnership interests in other businesses. So just have to be careful of the way those are structured. So basically what that means is when these are passive, you cannot, under most circumstances, use those losses against your ordinary income, and you can't use it to reduce your overall tax liability. The real benefit there of really those passive losses when you're not a real estate professional is it does shelter your rental income from tax, and you're not paying tax on your rental income, which is why even though for non-real estate professionals, real estate investing in general, when you're going to be doing it with rental properties, still has its tax benefits that could be very powerful. And really then when you're a real estate professional, those losses can become non-passive. And when they become non-passive, you can now use them against your other income. And that is like pretty much the cream of the crop tax strategy for pretty much anybody. If you're able to become a real estate professional and be able to use losses from real estate against your ordinary income, you're going to do significant damage, as we've discussed throughout the podcast so far. And also, there's one last thing to throw in there for people who are making less than $100,000 per year. You're going to be able to take up to $25,000 in passive losses against your ordinary income. That is going to phase out, however, between $100,000 and $150,000, $1 for every $2 of income you have above $100,000. And so once you hit the $100,000, $150,000 mark, all your losses are passive, and from real estate are passive, and they can only be used to offset other passive income or capital gains from passive activities such as a sale of a rental property at some point in the future.
So there's that caveat. Okay, gotcha. Okay, well then great. So let's talk about the cost segregation studies. Let's get a little bit more into that. I know that's very, very huge. A lot of people are talking about that and how it is very beneficial as well. So what does that mean to do a cost segregation study? What does that mean exactly?
So cost segregation study is essentially the practice of taking my purchase price of a building and allocating that to 5, 7, 15, and 27.5 year components. So I want to understand what goes into my building. If I spend $5 million on a building, I'm not just buying the building, I'm buying everything inside of the building. I'm buying the carpeting, the appliances, the cabinetry, the fixtures, everything behind the walls, like the electrical, the plumbing, the insulation, everything. I'm buying it all. So I want to assign a value to all of that, and we do that through cost segregation studies.
Okay, so what is the process? So you hire somebody, an expert in this that does cost segregation studies. They go out there to the property. They give you a value for all these different items, and then what happens?
Yeah, so at the very beginning, you would want to work with like a CPA, somebody like us, and we would kind of quarterback that for you. So first, we would decide, should you even do a cost seg study? If you're going to liquidate the property within 2 to 3 years, you might not want to do a cost seg study. And there's different reasons for that. But that's the very first question. So should you do a cost seg study? If yes, we're going to connect it to a few operators that run cost seg studies, and that's their main thing. That's what they do. They will typically, you'd engage with them separately. They're going to fly somebody out to the property to go through it, take pictures, analyze everything. They'll look at blueprints. They'll look at anything that they can get their hands on. Then they'll produce a report, and that report will be very detailed. It'll have like a value assigned to all the asset types, every piece of component that's inside that property. Then we take that back as a CPA. We review it, make sure that it makes sense, and then we get that into your tax return. Generally speaking, on a multifamily property, you can allocate 20 to 30% of the purchase price to 5, 7, and 15-year property. So if I've got a $1 million property, I'm looking at a $300,000 allocation to 5, 7, or 15-year property. And then thanks to the 2018 Tax Cuts and Jobs Act, we now have 100% bonus depreciation for any component with a useful life of less than 20 years. So if I make that allocation via a cost seg study, that $300K is allocated to 5, 7, and 15-year property. I take 100% bonus depreciation. Now I have $300,000 as a first year write-off whenever I purchase this property. I can then pass that. The write-off gets factored into my net operating income or loss calculation. Generally, the first year of ownership will have a net loss because the write-off is so huge compared to what the operations were able to kick out. So maybe I have a net operating income of like 100K in this example. I have depreciation of 300K, so my net loss is 200K. I then pass that back to my limited partners, and then things get really tricky if that loss exceeds the limited partner capital accounts, and then the question is, where's the excess loss allocated? But that might be a different discussion.
So is this something that's going to be continuing for many years to come, or is there a time limit on that?
So cost segregation studies have been around for quite some time. Not really sure exactly how long, but really the real power of the cost segregation study at this exact moment in time comes from the 100% bonus depreciation, which does end in 2022 and then phases out between 2022 and 2026. However, even without the 100% bonus depreciation, in many cases, there still are benefits to doing cost segregation studies, which is exactly why you do need to work with a qualified tax advisor who can advise you on such topics. But so just to kind of sum that up, yes, it does make a lot of sense right now, but they still make sense even without those benefits past 2022.
So it's very important that if you want to invest in real estate, and it shouldn't be because of the tax benefits. That shouldn't be the first reason why you invest in real estate. It should be because there's going to be the cash flow component to it. The tax benefits is an added bonus to it, right? So it shouldn't be the first and foremost as far as the decision on why you should invest. But if you're going to do it, then you have a window of opportunity here that's not going to be around forever, right? Because the tax laws will change here in the next few years, as Thomas just mentioned. So we'll talk about different tax strategies for general partners versus like limited partners. Does that kind of go along the same lines as doing a cost segregation study and kind of dividing that between the GPs and the LPs? Is that fair to say there for the tax strategies?
Yeah, so it's along the same lines. Typically when we work with a syndication, the tax strategies are all the same. So we're looking at cost segregation studies, we're looking at 100% bonus depreciation, and then we're looking at the business interest limitations. And then on top of that, if we have positive, especially if we have positive net income or a really big loss, we want to look at that 199A deduction, that 20% pass-through deduction. We have to kind of factor all of that into this analysis. But those are the four key things that we're going to look at every time we start up with a new syndicate. And then on an ongoing basis, we're looking at the tangible property regulations from 2013, and we're applying that to any sort of value add that's being incurred on the property. So if we've got, a property that's 100 units all under one roof, and there's 100 HVACs that are sitting on top of the roof or whatever, and we replace 10 of those HVAC units, the 2013 tangible property regulations say that that's not a material improvement to the HVAC system as a whole, so you might be able to deduct the cost of those 10 HVAC units as a repair rather than having to capitalize and depreciate the cost over 27 and a half years. That right there is something that a lot of CPAs miss and don't understand fully. They see a really big expense, 10 HVAC units, probably $50,000, $60,000. They see a really big expense and they automatically capitalize it. So we save our clients a ton of money just by correctly applying the tangible property regulations there. Yeah, those are kind of the key strategies that we're focused on. And then when we get to the loss situations, it's always how much capital account what is the aggregate capital account that our limited partners have? And if we have losses in excess of that, then it typically, depending on the operating agreement, will get applied to the general partnership. So then the question becomes, does the general partnership have basis in the entity? And that's also a whole new discussion. But
Yeah, well, see, it just goes to show that there's a lot of things out there that we need to know as investors. I think that the majority of my audience, are investors, right? And so I think it's very important for you to contact and to reach out to somebody that's a good CPA, somebody that has a good reputation, that knows what they're doing, that are truly experts, because these guys can really dig deeper and find out what is best for you. Things that you may not have known about, then these guys can really uncover a lot of different strategies and benefits that's really going to help you out in the long run. And that's the whole point, is for these guys to help you out to reduce your taxes. One thing real quick that I want to talk about is there's this term that is used and thrown around a lot that's called the BRRRR strategy. Is for buy, rehab, rent, refinance, and repeat. And this gets used a lot in the single family space: buy, rehab, rent, refinance, and repeat. But one of the articles that I came across on BiggerPockets was by you, Brandon. And this was I don't remember what the title was, but I remember that you said, forget the BRRRR strategy. We're going to use the BAR strategy, which is BA and then like 4 R's, right? So what does that A stand for? And why is it very, very important for us to have that A before the first R?
Yeah, so the A is advertising. And when you advertise and the property is completed, then you've got a property that is theoretically in service. And you can look at a bunch of tax court cases that really argue both sides of this coin. Now, I did get a lot of negative feedback on that article. In reviewing that article, I definitely could see how I gave the wrong impression. What my point of writing the article was just to have a conversation with your CPA about potentially strategically running a rehab, running the value add piece, and then placing the property into service. So the place in service date is critically important. If you can allocate any of the rehab after that date, then you are going to be rock solid from a tax perspective. And it gets really important when we're talking about our multifamily property, and we can put pieces of it in service at a time. So it's just my purpose of writing the article was just to say, go have a conversation with your CPA about this. But yeah.
Got it. So, yeah, the point was to try to have make sure that you pay attention to the in-service date, right? So that's why it was important for you to have advertising, before you start to have different costs for the rehab or capex or those kind of things.
Yeah, and I should say that one, you definitely cannot deduct all the rehab costs. You have to have a certificate of occupancy in order for the property to be ready, right? So that's going to automatically eliminate a lot of the structural stuff. But yeah, the whole purpose there is just have a conversation with your CPA about your place in service date. Is there any sort of value add piece that you can do after the place in service date? If so, that can be deducted. It's also become a little bit less important with the 2018 Tax Cuts and Jobs Act. We can now 100% bonus depreciate any components, again, with a useful life of less than 20 years. So there's also that factor to keep in mind as well.
Got it. So let's move on to the next section, which is our nuggets of wealth. These are questions that I ask every guest every week, and hopefully they are able to help out our audience. What is a good tool, source, or platform that you guys use in your firm daily that can really help any potential clients out there?
Oh, that's a tough one. There's a lot of stuff. We use a lot of different stuff. And to say if there's going to be a tool platform, I'd say the G Suite. There's so much different stuff that goes on in the G Suite. You could use, you have Gmail, the Google Calendar, it all syncs up together. G Sheets, there's a lot of amazing spreadsheets and solutions that can be ran out of the G Sheets that help you manage the financials of your business. So I think that it would probably be my number one, the G Suite.
Yeah, 100%. G Sheets are really big. We can run a lot of automations on G Sheets. So we actually run some of our clients' accounting on very structured G Sheets. It's
nice. Yeah, I use them all the time, and I think they're awesome. They're very, very helpful. What is the most common mistake that you see your clients make or potential clients make?
Yeah, so I see these mistakes all the time. Inability to correctly apply the tangible property regulations from 2013. So kind of going back to that example that I gave, inability to correctly take the de minimis safe harbor, not understanding the 2018 Tax Cuts and Jobs Act. Like if I put a roof on a commercial property, a 39-year property, I can fully deduct it under Section 179. Those are kind of the main things. But then just like forgetting to record the basis for depreciation, recording it incorrectly. We see a lot of CPAs double count closing costs. There's a lot of mistakes.
Got it. Yeah. So just make sure that, I think that the biggest thing there is to make sure that you get with a CPA, and get with them before you decide on a big, or make a big decision, right? Get with them, get their advice, get their opinion, because they'll really steer you in the right direction there. Okay. What is the one book that you could recommend to people that want to read up on tax strategies, tax benefits, something that can help them with their business or with their taxes?
I would say the NOLO Landlord Tax Guide. I forget what the actual name is. We also have a pillar page on our website called, what is it called? The Ultimate Tax Planning Guide for Landlords. So if you Google the Real Estate CPA and go and also the Ultimate Tax Planning Guide, you'll find it.
CommitToWealth.com, creating a legacy by committing to real estate wealth.